Hey, what's going on YouTube? Welcome to another episode of the Great Black Speakers podcast where we connect through conversation. I am your host, Lawrence Watkins. I am the founder and CEO of Great Black Speakers. I'm also the president and chief operating officer of the Black Business School. So today we're connecting you with a great friend of ours over at the Black Business School. His name is Castleigh Johnson, and Castleigh is the founder and CEO of TreeFigo. And he's going to get into all what TreeFigo is, but it's basically a credit app for millennials. But he's doing a lot more than that that he's going to explain to you today. But today we're going to be talking about how to get your credit lit before the upcoming recession. I think we entitled it "How to Get Your Credit Lit Before This Recession Hits." Because many of you guys want to buy houses, get into this multifamily real estate game. Want to get into other investments. And if you are looking to the bank for some type of loan or financing, you're going to need a great credit score. So today, Castleigh is going to give us some tips regarding credit and also behaviorally what you can do to continue to increase your credit score as well. So Castleigh, how are you doing today, man?
I'm doing great. Thank you, Lawrence and Dr. Boyce for having me on the platform, being able to share a little bit about our platform and what we're looking to build and just being good supporters of us, the Black Business School, being supporters of, our vision, what we're trying to help, our users and the larger community in general. So thank you very much to the team, and looking forward to sharing some of this information with the viewers and, passing along and hopefully get everybody up to that 800 credit club.
That's right. So we're going to talk about all about the 800 Credit Club. And before we do that, though, can you give the audience a little bit of background about what TreeFigo is, and then how have you gotten to this point in your career?
Yeah. So TreeFigo is a app online platform that we've launched primarily right now in Android store. But the purpose of it is to really simplify credit and personal finance. Why we kind of focused on credit is because credit's the foundation for personal finance. Most of the things that we kind of talked about, you brought up earlier, mortgages, multifamily real estate, cars, student loans, the foundation of that sits on top of credit and credit scores, access to capital. So that access to capital is highly regulated by this 3-digit number called your credit score, which most people don't understand. And the fact that you don't typically understand it is a disadvantage to you. It's information asymmetry, right? The less you know is the greater the person that's against you going to use that information against you. And not to say that all banks are going to be against you, but it's, again, like any kind of competition, it's a friendly competition. And the more you are empowered and the more you have resources, educational resources, access, and just knowledge about certain things, it'll help you to give you the best deal or the best access. So that's really what it comes down to, is that there's a lack of true understanding about how important this thing called your credit score is. And so we built this platform to be able to do that, to simplify what is a credit score, why is it important to you, and just to kind of get you that basic level of knowledge. And then after you get to that level of knowledge, then how do we help you to put it into action? So a part of it is where we just want to provide the knowledge, provide the access, and then how do we help you now with that knowledge, instill those behaviors, that knowledge into a behavior that you consistently do over time. And that's actually what helps to improve your credit score, is consistent action, the right financial action over time. That really is what is going to improve your score. So I'm not here for the get rich quick scheme, the 150 points in 30 days, credit score stuff. That's not what we're about. We're really about teaching people, like, here's the tricks of credit, right? Here's where, why credit utilization is important, why payment history is important. Here's what it looks like to a bank. Your credit score is your credit GPA. So if you got a 3.0 and the minimum is a 3.0 to apply to this job, you can apply. If you have a 2.5 and you apply to a 3.0 job, they're going to reject you. Mm-hmm. Similar aspect with your credit score. If the minimum to get this car loan is 650, you got a 620, not going to get it, right? So it's those principles that we want to simplify for people. Hey, why is this important? access to this capital. And once you get access, now there's levels to this, like levels to this game. You might just qualify. You're at that bottom of that brink, but hey, I'm gonna give you, 9% or 8% on this mortgage because you just qualify. But if you qualify, again, as you move up that scale, you qualify really well, get into that 750, 800 club, I'm gonna give you 4%, 3.5%, especially on big numbers, a 300,000, 400,000, $500,000. Those are huge, huge implications, right? More student loans. Average folks are now getting out of school with 100,000 undergrad, right? So if you're getting 100,000, that's almost a mortgage, and you're paying 10%, 8% interest rate on that 100,000, you're in the hole for the next 25 years.
Right.
Right. So, but if you have a good credit score and you reconsolidate that student loan, you can come down to potentially a 5.5%, 6% interest rate. So those are the types of things that we want people to understand.
Got you. And I want to get really deep into that. But before we do, can you tell the audience in terms of how you came up with the idea of TreeFigo? Like, what was the thought process of you even coming up with this app?
So made a couple mistakes when I graduated undergrad myself a few years ago. Didn't fully understand credit. Had a couple credit cards. You were kind of given to me relatively easy, and making some money, and wanted to ball out and live a certain lifestyle, which I did. The only thing I didn't do wrong was I never missed a payment. But most of the other stuff, credit utilizations, applying for a bunch of cards at the same time, hitting my credit inquiries, all of those small things, pulling my average age of credit down by opening new cards that I never used just because I wanted to have them. Those kind of decisions jacked up my credit for a long time, right? And so I kind of started looking at that a little bit later as I kind of got a little older and was like, this kind of credit score thing is a little important. Then I got into business school. So I got to Stern at NYU and, started kind of talking kind of informal conversations with my peers and, my non-minority peers. And we started just kind of talking about credit scores in general and to see what their credit scores were typically compared to, mine and others like me was a pretty big gap. We were one of the best business schools in the country. And there were still differences with the same student base. Right. So, and then talking to immigrants, because a huge percentage of NYU's student base, at least the business school, is international. So them cats didn't even have credit scores. So they had a whole set of other issues with access to capital. So, kind of going through that, then worked at the New York Fed in the last financial crisis in 2008. And I saw the devastation among certain communities, how that crisis impacted communities a lot more than others. So if you look at foreclosure rates and delinquencies kind of segmented around certain cities and neighborhoods, they look like me, right? And, there was prior to 2009, FICO and the agencies didn't have to actually tell you how they calculated your credit score. It's kind of like this hidden secret. Congress passed a law that made them have to kind of give you some guidance. But even with that, there hasn't been a lot of penetration in the minority community in this area. And especially minorities, especially kind of also the millennial, the younger kind of consumer. So those kind of two subsegments, it's like, all right, no one's kind of really doing anything around that huge, Black and brown population. And I, have the knowledge for it, been to business school, worked at some of these major banks and various senior risk roles. Why don't I take that knowledge and actually do something? So I myself, I've made a lot of mistakes, built my own credit score. I'm in that 800 club, so I'm sitting pretty good now.
Congratulations
to
you.
You know what I mean? I'm picking up like 10, 15.
Got them good interest rates.
Bruh, like my credit cards, bank is losing money, loaning me money right now. And I got all fixed rates. So that's another piece, another trick to the game. If you can on credit cards, always stick to fixed interest rates. Because that variable interest rate, even the intro, is a setup. Because that means you got to check LIBOR or whatever benchmark rate that is every 3 months, where they can change that interest rate on you. And 98, 99% of people will never check that benchmark interest rate. Right. And see where it's coming down at. Now the Fed just lowered basis points another 25, so you might get a little helping they're on the 25 bips, but in general, it's going up. So if you sit with a fixed interest rate, you offset that risk to the bank versus yourself. They're locking in their spread when you take a variable interest rate card. Mm-hmm. That's all they do. They lock in their spread. And we can kind of talk about what spreads are in the future, but if they have a fixed rate, now you kind of offset to say at some point you're going to get a little bit, some point I'm going to get a little bit. In my case, I'm always winning. Just my cards. But you know what I mean? So those are some of the things that kind of why I started to look at, knowing the problem that's out there, knowing anecdotally that I had a lot of friends that had terrible credit scores. Myself, I was in a bad credit score spot for a while. What are we doing to fix that? And I'm not relying on somebody else to come fix a problem that I have the capacity for and the passion to kind of work with, and seeing that the numbers are still there. So I started this company in 2017, but I've had this kind of thought process in my head for a couple of years. And I looked at different iterations of it to really think about how do you help a set of people empower themselves. Right. So there's a bunch of different ways to it. Like credit, again, is not the end all be all, but it's like building a house. You need a solid foundation. And what credit usually does is it actually teaches you discipline, because that's really what credit is going to do. So that discipline in terms of understanding, cash flows and expenses, and not going splurging and balling out even when you can, and making smart decisions like, hey, if I put down my utilization, and I'm cut down from 11 to 9%, knowing the game, that 10% marker is a threshold, that bumps my credit score a couple more points up because I'm below that 10% threshold, right? So once you kind of get those little tweaks to the game, this thing becomes like, basic stuff.
Well, we're going to get into it now, right? So for the next 37 minutes or so, we're going to get into all of these different things as it specifically relates to credit from a strategic and also tactical standpoint for everyone. But for the people who just tuned in, I'm here with Mr. Castleigh Johnson. He's the founder and CEO of TreeFigo. TreeFigo is an app for millennials and minority communities to help them understand and utilize credit to the best of their ability. Today, we are talking all about credit and how to get your credit lit before the recession hits in 2019 as well. So if you guys like this video, like what we're talking about, please go ahead and press the thumbs up button, show us some love, so YouTube algorithm can show us some love as well. All right, so Castleigh, let's just start from the basics. What is your credit score at its basic? We all have these numbers. We all kind of understand what these numbers are to a certain extent. Yeah. But let's start with the very, very basics, because I think there's a lot that can be learned if you understand fundamentally what something is. So fundamentally, what is your credit score?
So your credit score is really a third-party indicator of financial past responsibility. That's typically what it is. All right, so let me try to simple that down. So I don't know you. I'm going to give you access to money, typically a loan, credit. How do I get some type of comfort level with the chances of you paying me back, right? You honoring this financial contract. And that's literally what the credit score's main basis is for lenders, creditors who are giving access to services or capital to people who say, hey, I don't know Tom, Jim and Lawrence, what's their past history or past financial responsibility been that's going to give me comfort to know that they're going to kind of, honor my contract and pay me back. So that's what that's the essence of what they're trying to calculate. Based on 800 credit score, high probability you'll get your money back, 99.3%. And there's a lot of data behind it. So what they end up doing is looking at a lot of past payment history data for the general population and saying, based on these kind of characteristics, and that's kind of what the information that's in your credit score, your credit report, based on this data compared to the general population and all these other people that have done certain things, and it reflects certain pieces of your information, what's the likelihood that you're going to pay me back? So that 700 credit score is attached to a delinquency score. And that's when you don't pay somebody back. So the higher the delinquency score or relative is the lower your credit score is going to be. So for example, somebody that has like an 800 plus credit score, very low delinquency. You're talking about like 0.2%, 0.5% of chances that you miss a payment in the next like 24 to 36 months, right?
Mm-hmm.
Low risk. I'm good with lending Lawrence money. Lawrence, 800, cool. There's a very low probability you're not going to pay me back, right?
Mm-hmm.
With this 2%, 4% interest. That's why I also lend you pretty low, because you're pretty good at paying people back. Cool, rock with me. Now, when you got like a 550, 600 credit score, you might not pay me back pretty high. So you're probably looking at somewhere near like a 25% delinquency rate, right? 30% delinquency rate, depending on the products. And another piece is that delinquency rates go by product. Product being car loans, student loans, credit cards, mortgages. So there are actually credit scores for each of those products. So the average person, what they don't realize is that you actually are walking around with like about 50 to 60 different credit scores. Because each of the bureaus calculates a score, but then there's all the products that there are that you potentially get a credit score for, right? So you have actually an auto insurance credit score.
Right. I didn't know that. Okay.
So, but the one that people typically get on their Credit Karma or even on our app is your general obligation score, right? So you have this general obligation score, which is it's close. Now the credit scores, all these different credit scores are within some type of variance. So you're not going to see somebody has an 800 on one and a 600 on the other one. They're usually within some type of range, right? So the game is like, how do you make sure that your credit score in your report reflects the best of you? Because that's really what it comes down to. I don't know you. Same way when you apply to a job, right? You send your resume in, you put your GPA on there, especially when you graduate into school. Your resume and your GPA is what is going to kind of make or break you. Same way with you applying for a loan. You do it through these systems, or you go to a bank, they look at your credit score, they look at your report and say, hey, based on this data, what's the chances this person is going to actually pay me back? That's it.
I love it. And, if we put some numbers to it, I don't know if you know these numbers or not. So you mentioned the delinquency rate of someone who has a 550, 600 credit score. What is the median credit score in the United States? And then what's the delinquency rate associated with that credit score, if you know?
The median is about 700 right now. I think between 7 and 705.
Okay, so between 7 and 705. And
delinquency rates on those are relatively low. I think they're about between 5 and 7%.
Okay, got you. So an average person, 5 to 7% of them, or a median person, whatever, between 5 and 7% of those people will be delinquent
within the next 36 months or so. That's kind of closely what they're trying to get to. But then you have subsegments of those scores. And this is where, unfortunately, Black and brown people come in. So the 700 is prime, right? So 700 is about average, it's prime rate. It's a prime number. The average for the other folks that look like us is around 650, 660. So you're subprime or near subprime. So those delinquencies are like 17%.
Got you. So, those delinquencies go up, when you get down to, that type of level.
It spikes a lot. That's another reason why banks typically don't like to lend in that 650, 620, 650 range, because the delinquencies don't match. They're much further off from like a 700. 700, you have a 5% chance. All right, cool. I can compensate with that with a little bit higher interest rate. But you're looking at, 17, 18% chance, much higher probability you're going to kind of miss a payment and end up in, cost of recovery. So now I'm going to end up with this bad loan in collections. I'm going to sell it off, end up going through that whole write-off process. It becomes a lot more cumbersome. And, there are real implications to the banks. So that's why a lot of traditional banks don't really like to play in that subprime space.
Well, let's talk about that then a little bit more, right? In terms of, we know credit is important, right? And I think you touched on it a little bit earlier. Can you talk about, from two different perspectives, what are all the areas in our lives, or the most important areas of our lives where credit actually touches that we may or may not even think about? And then also talk about, I want to go deeper into this interest rate thing, because I don't think people fully understand the power of compound interest. 8% credit, 8% interest rate versus 9%. can be drastic over the course of a 30-year loan, especially if you're talking about a house. So let's talk about that for a little bit.
So yeah, it gets deep, right? The thing about it is kind of interesting is that you're looking at, delinquency rates and credit scores across a bunch of different spectrums, right? So credit scores in kind of that 600 range, credit scores in the 700 range, credit scores in the 800 range. And with different APRs associated with that, that's your cost of capital, right? Your interest rate, AKA cost of capital, what's going to cost me to get in? First, you got to get in the door, right? So different banks, different institutions have different underwriting standards and underwriting minimums. So that's why you'll see some banks say, hey, we'll accept this risk at 16% interest, at 15% interest. Some banks will be like, even at 15%, I ain't touching it. All right. So there are some different, not regulations per se, but different underwriting standards for different institutions and different profiles, because they think they can get a little bit more juice on their spread, kind of playing in different tranches. So the piece that's kind of interesting is the part where you talked about that people don't realize from credit score. The one piece that most times folks don't think about is that job offers can get pulled because of credit scores. Most folks don't think through that real quick, especially in financial institutions. So I did all the work, got my good resume, went through the interviews. You submit. So after you get the job offer, you submit that piece for them to do a background check. Your credit score is part of that background check. All right. So in that, the banks actually, especially banks, not all institutions, some even insurance companies, depending on the type of position you have, they do have the right to rescind an offer because of bad credit scores. That's ones that people sometimes, your livelihood can be affected by your credit score, your auto insurance rates. So if you have the same driving record, same 15 years, same accidents or no accidents, and you have a 600 credit score and you have an 800 credit score, your actual your cost of your insurance can be almost double.
Wow.
Zebra.com did a study on this. Actually, one of my boys is pretty senior over that organization that compares cost of car insurance across the nation. And your credit score is a significant implication, because here's what the insurance company is saying, especially if you're on monthly payments, I want to make sure I can get my money from you. And the consistent people that pay are usually the higher credit scores. So if you don't pay, I'm going to charge you a whole lot more, like from a delinquency standpoint. So car insurance, you don't typically think about that, but that's a significant impact. Your actually life insurance policy runs your credit score too. Health insurance, they can't, but life insurance, they can. So those are just a couple. And then when people think about their credit scores in general, what they fail to usually do is compound all of the things that number touches. Mortgage, car loan, your student debt, your credit cards. And so you got to look at from a cost of living spectrum across all those. So when you think about your mortgage and it's a $400,000, $500,000 house, 7% or whatever, and you look at it and say, hey, that's a high cost for that thing, you got to look at it like, hey, I'm paying 25% interest on my credit cards too. So if you move that one number up, you can cut all those across the board down. So that's the piece that is sometimes it's like, how do you turn on that broader vision to see that this one number impacts such a bigger base of your cost of living?
And I want to touch on that a little bit more in regards to after someone turns on that switch, how do we play the game better than everyone else plays the game? And, I want to know your take on that in one moment. But before we get to that, just as a reminder, everyone, I'm here with Castleigh Johnson. Castleigh is the founder and CEO of TreeFigo. TreeFigo is an app that is for millennials and people of color, really anyone who wants to learn how to utilize their credit better and to increase their credit scores. And today we're talking about how to get your credit lit before the recession hits, because if it hits, you don't have good credit, then your access to capital will almost be zero. Because it'll be almost impossible to increase your credit during those times as well. So if you guys like this video, please go ahead and press the thumbs up button. Show us some love.
Let's
So
get it.
Google's algorithm shows some love. Make sure you share this video and subscribe to our YouTube channel as well, the Black Financial Channel. All right, Castleigh, let's talk about it more then. Let's go even more in depth in terms of strategies, right? Mm-hmm. So, credit is a game in a way. It's supposed to reflect, how likely you are to pay someone back, trust levels, those types of things. But what are the main factors that actually affect someone's credit score? And if you put a gun to somebody's head, what would you recommend that they do to increase their credit score, most rapidly?
Well, we're going to stay off the gun, but hey, if we want to get that, we want to trigger you. So if you use another gun term, we're going to trigger you to action.
Trigger to action.
Yeah, trigger to action, right? So, there are 5 main categories in the FICO scoring model. And FICO is the base model behind where most of your credit score calculations that the banks and financial institutions use. So the 5 main categories are payment history, credit utilization, average age of credit, credit inquiries, and which ones? I forgot the 5th one. It's like small. But the 2 main categories actually that you need to pay attention to is payment history and credit utilization. So those 2 account for 65% of your score. So payment history accounts for 35% and credit utilization accounts for 30%. And those are the 2 main ones that you can handle most proactively. Like average age of credit, you can't really do anything about it. So it's kind of a length of time kind of account, as well as how many recent inquiries you've had. So you can do stuff by not doing stuff in that category, or credit inquiries. Hey, don't open any new credit cards or request any new access to capital for the next 24 months, because it's a 24-month time frame that's those inquiries sit on your credit report. So if you kind of know to keep it under 2 to 3 credit inquiries in a 24-month time frame, just check on your credit report and see how many you have on there, and make sure you don't really go above that number too often. Because then that we start to get to 5, 6, 7, 8 inquiries. It makes you look desperate from a score perspective and from a bank perspective. So then they start to it's going to impact your score, but then they start to question, why are you reaching out for so many different parts of credit in a short period of time? But the 2 main ones, again, are payment history and credit utilization. So payment history, always pay your bills on time. That's the simplest, right? And yes, sometimes we can forget. The easiest way I do it is for any fixed expenses, I automate them. So anything that's a fixed expense, my mortgage is monthly, my rent is monthly, my student loans are monthly, my car payments monthly, it ain't going to change. It's an installment account. Pay that. Just have the automatic payments set up out of your checking account. And, monitor them every month, make sure that they're gone, they're paid, and you can set up reminders. I set up reminders to know that, hey, these bills are due, but I make sure my automatic payments are set up at least a week or a couple of days before the due dates. So just in case something messes up with my bank, I still have some time, right? You don't want to kind of set your payment date on the 30th, your bills are due on the 30th or 31st, then you don't really have, so if your bank ever messes up, you need to leave yourself some room. So I typically try to put about 5 to a week out, and then, have a couple of reminders to make sure that they're gone. And then for other pieces, for credit, and the other piece is credit utilization. So with the credit utilization, that's on revolving accounts. So revolving accounts are your credit cards, any type of revolving lines of credit that you may have out there, and you want to keep those under 25%. Now, people will say 30, I'm going to go 25, right? Because yes, 30 is kind of one of the barometers for cutoff, but 25 gives you a little room, right? So if you do get to that 27, 28, you're not hitting the 30 plus. 30 is kind of where you'll see the better scores. And really people in the 800 typically have 10 or less. But if you want to get to that 700 plus to get in a good space, you're going to see typically around 30, underneath 30%. So I'm going to say aim for 25 if you can. And you definitely need to check to make sure what is there on your credit report for opened lines of credit and what your opening balances are. So when it comes to you can calculate your own credit utilization. So they will give it to you, but the basic calculation for credit utilization is what's the total amount of revolving capital you have access to. So again, typically your credit cards, any type of revolving lines, anything that you can move up and down in a particular month with your choosing is typically revolving, right? You can make that payment. There's no prepayment penalty. But then when you pay that down, you get that access back. That is open available credit, right? Then you want to, so that's the bottom number. What's the maximum total numbers of credit cards and those things? And say you have 3 credit cards, 10,000 each. Total is 30,000 available credit. Now on those 3 cards, I have 2 balances that I'm carrying, 1.5, 1.5, right? So I have 10,000 of, current balances being used. So again, put that 10 over the 30. What's my utilization? 33. All right. So that's where you got to make sure you understand where those numbers are. And then how do you manage that? Now, the 2 ways to attack utilization. So for payment history, always pay your bills on time. I'll come back to what you can do if you've missed the payment. But let me kind of still focus on credit utilization. Credit utilization, the 2 ways to kind of play with that is to actually take some of your extra cash flow and pay that down. So you'll reduce the number of open balance. If I have an extra $1,000 this month and I throw it to my 10,000 that I owe, I'm bringing it down to 9, right? That now my utilization number comes down. So again, I kind of play with that a bit. So use that extra cash flow if you have it. That's one way of addressing it. And that's the way that I would promote the most, because it teaches the discipline of cutting your expenses down and then using extra cash to attack something like your credit utilization or your open balances, right? Then the other way of actually pulling your credit utilization down is to literally open another line of credit, open another credit card. So now if I have these, this $10,000 amount that is open, I have 30,000 of total credit available right now, and I take out another $10,000. Now what does that go to? So now I have 40,000 of available credit. Once I get that, and that goes up over 10, that's still open, 25%, right? So the thing about that is 2 things hit. What people typically don't also do the calculation. Now I have a new credit inquiry that what I just said before hits my credit report. So depending on how many open credit inquiries I had before, this one inquiry could push me over into one of the higher risk categories for credit inquiries. So again, always know kind of how many credit inquiries you have sitting on your credit report are hard inquiries as well. Because me looking at my own credit report is a soft inquiry. That doesn't do anything to hurt me. Hard inquiries are for lines of credit access that you've accepted or you've directed a institution to run on your credit report. And those are the ones that count. Hard inquiries versus soft inquiries. Soft inquiries, hey, I'm using the TreeFigo app to look at my credit score. That's a soft inquiry. Will not show up on your credit report. Don't even worry about it. But on the hard inquiries, again, pay attention to those. Now, the other thing that it also hits is average age of credit. So now I have a new credit line. If I had, say, 10 years of average credit, because I had a card from 20 years ago, and then my last card I took out was 2 years ago or 3 years ago. And so I have a 10-year average age of credit. Now that 10-year average age of credit is going to come down to maybe 9 years and 2 months or 3 months, depending on, again, the length of history that I have and when was the most recent cards or when were those other cards that I have, were they opened? So that's kind of the game that you're going to get a hit on average age of credit. Now, if I have 15-year average age of credit and it comes down to 13, it's actually not going to be that bad. But for the typical younger consumers or people that have opened more accounts recently, that's going to pull your average age of credit down. So if you kind of drop from 10 to 8 or 7.5, that's going to be a pretty decent hit on your credit score. So account mix and account total, that's the other one I forgot to mention before. Account mix and account totals, again, can't really do a whole lot about them. Those are like
account total. How many accounts that you have? Is that what it is?
Correct. Yeah. Okay. How many open accounts on your file?
Okay, gotcha.
On your credit file. So between TransUnion, Equifax, and Experian, how many accounts do they have on your files on there? So there's kind of a sweet spot number. They're looking for anywhere between 15 plus accounts. So that's kind of also another interesting one where you want to have a decent number of accounts and account mixes. So there's some parts of where depending on the particular model, they use a calculation for an account mix. They want to see installment and revolving accounts. So they want to see some student loans. They want to see some credit cards. They want to see some auto loans. They want to see a mortgage eventually on there. Not all the time, like immediately. But if you have nothing but credit cards, you have 7 credit cards, your account mix total, depending on the model, becomes a little off because now you're heavy revolving base and not revolving and installment. So it's an interesting one depending on the particular model, but some models lean towards more of account mix in terms of installment versus revolving, and some lean to just straight account total number. So we want to see 15 plus accounts reported over the period of the last 5 or 6 years.
Got you. No, that's some excellent information. And, I want to get into, before we get out of here, I want to get into some things regarding what do you do if there's something on your credit report that shouldn't be there? And then what do you do if you miss a payment and other things that could actually go wrong? And if you're proactive, you can fix before it actually, damages your credit report. But before we do, everyone, I'm here with Castleigh Johnson. Castleigh is the founder and CEO of TreeFigo. TreeFigo is an app for millennials and people of color and other individuals to help them manage their credit, to learn about their credit more, so that they can get those best interest rates, and so that they can live a healthy financial life as well. So today we're talking about how to get your credit lit before this recession hits in 2019. If you guys like this video, press the thumbs up button, and also please make sure that you subscribe to our YouTube channel as well. So Castleigh, let's talk about what do you do if you miss a payment, and what do you do if there's errors. Like something? Yeah, there's errors.
Errors.
And how can you fix errors or do other things? If you have in a bad position, you want to improve your credit. What can you do to tackle it from that perspective?
So I'll start with the payment history one. So we'll just go with that one. All right. So payment history. You can actually request creditors. So there's a process behind this. So Lawrence, whoever, I've missed a payment, my credit card, I forgot I was on vacation, yada, 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 missed the payment, came back, realized it, say whatever, a month later, you sent me the letter, 20 days later, 3 months later, whatever the time frame is. I can actually, so my first thing is to get that payment caught up. So pay that, get that back to current. So if I missed $100 and then my next bill was $100 and now I got $200 in the hole, plus fees if they put on top of that, I have to get the account current. So that's my first thing I want to do. So I want to pay that $200 plus interest or penalty or whatever that has occurred, get the account current. Then once I get that current, I can then reach out to the creditor, to that financial institution, say, hey, I send them a letter. So there's some form letters like this, and we're actually going to be embedding this into our app. And so kind of a cheat code. We want to have a simple cheat code. And our CFPB has this. So the Consumer Financial Protection Agency have this on their website, some general forms, but we're going to embed it in our app upcoming. But it's really around, hey, I'm a pretty good, customer of yours. I had this, issue, and, whether I was laid off, I was on vacation, I was, in some kind of difficulty where I've missed a payment, but I've got the payment caught up. We would greatly appreciate it to continue the relationship, to have that missed payment removed from my credit report, and for you to send the file or send a letter to all 3 bureaus requesting that this missed payment be taken off my record. That's literally the gist of the letter. Hey, Mr. and Mrs. Institution, missed the payment, whatever reason, made up that payment with the date. It's still on. I've seen this thing is on my file in all 3 of the bureaus. Please have that removed and send me the confirmation as well that you've requested for the bureaus to remove this item from my credit score.
And how successful is that letter?
Oh, pretty successful. It's really successful. That's the piece. Again, that's the gem that most folks like us do not realize. They don't get a lot of those letters, and especially a lot of those letters from us. So again, if you have it now, you can't send that letter every 6 months. That's again, we got to play this game right. If you're going to play this game, play it right and know the rules and respect the rules. You can send that letter once, maybe twice in a 2 or 3 year time frame. Like you can't say, and it shouldn't even be 2 or 3 years. Again, you missed up on it. And this is, again, not the same institution. You're not going to send the same letter to Discover Bank or JP or Morgan or whoever. Again, hopefully the thing about it is the behaviors, right? We want to teach you the right behaviors, but again, things happen in life. How do you kind of make sure that you have a little bit of leeway to adjust that if necessary? So that's what we're trying to say. So it's like a one-time thing. Now, if you've missed 3 payments over the last 12 months, you can't really send that letter. I'm going to keep it 100. They're going to look at your track record, again, your payment history, and be like, well, even if we took this off your report, you're probably going to do this thing again because you've established a pattern that ain't good. Mm-hmm. So the thing about it is, if this is not a consistent pattern, then you can send that letter, and the effectiveness of that letter is really high. I can't give you no numbers, but I would say it would be in the 75-80% range, where they will actually have that, especially when you've got it caught up, because they want to keep you as a happy customer, right? So it's a bank, it's Verizon or whoever kind of sent that delinquency note, missed payment. They potentially want to keep you as a good, happy customer and to keep your relationship. So use that piece in that letter. So that's on the payment history side. But again, don't keep sending these every 6 months or kind of rotate them throughout your institutions. That ain't going to work because the bureaus themselves ain't going to take it off. They're going to look at that and be like, all right, this is a game that you're playing, but we play this game better. So it's around being smart. And, again, things are going to happen, mistakes are going to happen. And, you address those mistakes. And that's what the letter's for. Hey, stating whatever the concern or mistake was, but I've caught up. I'm good. Now help me out to continue to be a good customer. Take that, missed payment off my report. And you're typically going to see your bump score going back up once they pull that off your report.
Now that's interesting. So approaching it from the bank perspective, because you hear a lot of people, disputing a lot of things from their credit reports, right? Mm-hmm. So how do the disputes play into this too? Because that's not necessarily a dispute. They're saying you're owing up to the mistake, but please remove this so I can continue to be a customer of yours, right? So
there's 2 types of disputes. So thank you for jumping into it. So there's a dispute where there's an actual error in your report. This should not be there. This is John A. Smith that, has some error. Some delinquency or something. I am John C. Smith. That is one type of error where it's clearly on the bureau or the creditor who put the wrong information on your report. Now, the problem is the bureaus weren't doing a really good job of quality control for a while. So they have now gotten better, but for some time, the actual accuracy of these reports was pretty terrible. And because the onus is always on the consumer to make sure that information is correct, even though you don't have access to your report on a day-to-day basis, it's on you to check your report to make sure that is accurate. So when somehow some erroneous thing ends up on your report and you don't check it for 2 years, 3 years, and it's dragging down your score, it's on you. Right? They kind of wash their hands and be like, hey, we gave you this free one-time access thing. You never paid attention to it. But this is, again, why we kind of developed our app and platform and say, hey, we'll make it easy for you to check it and keep continuously monitoring it. Right? But so that's one set of errors. And that one, all you have to do is send them a letter once you find a report, and you do an online dispute. And you just submit each, but you have to do an online dispute to each bureau. You can't do one and then saying like, hey, that's off. You have to literally submit the error online dispute to each of the bureaus, Equifax, TransUnion, Experian, and say, hey, this is the wrong information. Take it off. And you have to prove that it's me. And once you can't prove it's me, you have to take it off. You have 30 days. So that's actually what people don't realize. So unless that creditor, the bureau can talk to the creditor and prove that information is you, which they can. If it's a true error, they have to take it off in 30 days. And then you have to just send them in the dispute. So each of the bureaus have their own online dispute portals. Just make sure that they send you confirmation. And they'll say, if they do come back with something, here's our evidence. Again, if it's wrong, they can't come back with evidence. Or the evidence itself will be incorrect, so you never really worry about that.
What do you think a strategy is? Is just disputing, just to dispute?
Oh, you
everything.
Can. Oh, yeah. So then again, another piece. So now there's the other side of errors. So I told you there's two gas sizes game, right? Now the other side of errors, like that's a true error. Now, other pieces like, yo, I'm shooting Steph Curry out the block, right? So I can just dispute everything. Now, the interesting part about that is if the actual creditor doesn't have the correct paperwork to actually hold you accountable for said thing that's on your credit report that's negative, they actually have to remove that. So that's the game that people are playing too, right? I get that. So I'm Steph Curry and I'm shooting 40 feet. I might hit 1 out of 3 or actually, I'm going to hit 1 out of 5.
Yeah.
But I'm going to get one. I'm just going to chuck it. I'm 40 feet in it. So you can, but again, the legitimate organizations, the larger organizations, the JPs, a lot of the big banks, they're going to typically have their paperwork. So if you're trying to dispute certain things from some of these other institutions, you're going to be shooting them bricks hard. But there are smaller institutions, some of these volume payday lenders, some of these other kind of shady cats that are out there that, yeah, you did take out the money, but they didn't do their paperwork right. So they can't necessarily prove that you did. Hey, Steph Curry, you probably could get that taken care of if they don't have the paperwork to prove it was you. So that's the other side of the game where, yeah, you can dispute everything. Like, hey, if you don't have that actual record to actually identify me as that person, it has to go. So, hey, but that, again, there's the true error where they can't produce it because it ain't you. And then there's it kind of is me, but I'm going to play this game and you have to be able to back up your stuff. And if you can't, that ain't me.
Steph Curry with the shot.
Yeah, Steph Curry with the shot.
Yeah, man. So I know you have to get out of here. There's so many more questions I want to ask you. Right? I know you have to.
I think we can definitely do a re-up on this. Folks, put us in the comments. Let us know your thoughts. This hour went by pretty quickly, man. But we got so much more we can share on this topic, right? Because there are so many levels to this. Like there's layers to this. But at the end of the day, the basic thing I want to kind of leave people with is that this thing is about behavior and mindset, right? And if you have the right mindset, it'll lead to the right behavior. Obviously, you need the knowledge first, and that's where we're trying to drop some gems here. Black Business School's been dropping gems for years, always been a supporter. Boyce, Lawrence, the work you guys are doing is phenomenal. I'm dropping a couple gems kind of on the credit side, but it's around, the behavior. It's around teaching you the tricks of the game, what the game is. Learn to look at it from an external standpoint. That if I'm looking at it like, think about it. You have cousins that you would not lend money to. Because I know if I lend money to X, Y, and Z, I'm not getting that money back. Same way as the way you're looking at from a financial institution standpoint, right? I know if I lend money to Boyce, I ain't worried about that. He get back to me 6 months. I'm not stressing it. But if I lend money to, Steve over here, I might write that off as a charitable donation. It's gone. And so you don't want to be that charitable donation. So how do you make sure that you have the right behaviors and mindset so folks will be like, hey, I'll cut you that check. Holler at me in 6 months, holler at me in 3 months, because I'm not worried about you not paying me back because you're a person of principle. That's really what it comes down to, right? Let's think about it. Person of integrity, person of principle. And that's your honoring your financial contracts piece from that earlier side that I said. And so if you're a person of principle, I'm not stressed. But if your record shows your street cred is suspect, your street cred is your credit score. And if that's suspect, I'm going to look at you like, I don't know if I'm going to really cut you this check, bro.
A Lannister always pays his debts, right?
Look.
Or so they say. No, I love it, man. I love it. Yeah. So if you guys like this video, actually, Castleigh, how can people download the app? How can they get in touch with you? If they want to know more information.
So our app now is available on the Google Play Store. So just, go on Google Play on your phones, download TreeFigo, TreeFigo. Welcome to the 800 Club. That'll pop up pretty early because we want to get you in that mindset, right? So that's the easiest way to kind of start, taking some action, learning a little bit about credit. And then for me, you can actually just reach out to me directly. My email, I'll give you my email, is literally Castleigh@TreeFigo, CASTLEIGH @TRIFIGO.com. I'm open to feedback. I'm open to sharing insight. Just really want to try to help as many folks as we can. Again, thank you to Lawrence. Thank you to the Black Business School. Thank you to Dr. Boyce and the team. And, shoot us some questions. You guys want to see part 2? We can make this a series. I got gems for days out this game, how this game is run. And especially with an upcoming recession, there are levels to this because the implications of your credit score get much tighter because capital tightens in a recession. What does that mean? Folks stop lending to certain people. And so you don't want to be at that point where you can't get access, because if you in a recession also becomes great market opportunities. All right. So when you see real estate prices start coming down, be like, oh, I can go get that house now that was 100,000. It's going on sale for 60. Mm-hmm. Right. It's foreclosing. It's so opportunities happen in recessions, but you have to have access. So we're trying to get you in that space where you will be able to have the access and be able to take advantage, because that's how other people take advantage of recessions, is they have access to capital, but they also have some of their own capital to put into play, right? So when you have that right mindset is when you start saving and living under your means, you have a little bit of excess capital that you can use as equity in a debt deal as well, right? So you coming in, putting in 10% and you borrowing 90. But again, banks be like, hey, based on Lawrence's street credit and his credit score, I'm cool with that. I see what this dude's, always pays his debts back. So I'll let you get that 90, right? And you put a little skin in the game. So you put a little skin in the game and you can put, your skin could be 3%. Know what I mean? But it's how do you understand the dynamics of what it looks like from an institution cutting you a check and then making sure that you deliver on that and continue to deliver on that, so that behavior, that repeated behavior, is all your credit score is going to really do. It showed that repeated positive behavior.
Got you, man. You dropping gems, dropping that knowledge. Everyone, let's give a virtual round of applause to Castleigh for coming in here today. If you all want to see a series, get your credit lit before this recession hits series, please let us know in the comments. We read the comments, and if you let us know, we'll make it happen as well. But let's just, like I said, give a round of applause to Castleigh for coming in today. Thank you for your time. Before you guys get out of here, please make sure you press the thumbs up button. The more love that you show us, the more love that the Google algorithm shows us as well. And then, man, and make sure you share and subscribe to our content also. So go ahead.
No, I was saying you've for folks that just want some lighthearted comedy as well, please check out our YouTube channel as well. And it's just TreeFigo on our YouTube. You'll see the story of Sean on there, which is an interesting series that kind of takes people through, somewhere that doesn't understand credit and seeing the life journey and the story kind of unfold, where they understand how impactful this credit thing and what does that help you to achieve, right? Being able to get your first apartment, get your car, your mortgage, all that stuff. Check out our YouTube channel as well. Again, support Dr. Boyce, support the business school, get your thumbs up in, share, like, comment, anything you want us to expand on that, maybe some things I rushed through, whatever the suggestions are, we're open to hearing that. And we just want to make this as impactful for you guys as possible. So, share some love, all that good stuff.
All right, everybody. So on behalf of Castleigh Johnson, the founder and CEO of TreeFigo, my name is Lawrence Watkins. I am the president and chief operating officer of the Black Business School. Thank you for tuning into another interview on the Black Financial Channel. You guys take care, be blessed, and have a wonderful day. All right, bye-bye.